And we are live. Good morning, good afternoon, good evening, good day. Just depends on where you are and when you are watching this broadcast. My name is Clara Lyons-Devaughn. I am the broker owner of Lyonsview Realty. We provide residential, commercial for small businesses and nonprofits and property management services. I'm trying to get my stuff together here. Thank you for joining today for Lyonsview Financial Fridays. We stream live on Facebook and YouTube at 9:30 a.m. Eastern Standard Time. Please take a moment to share this broadcast with others. Here at Financial Fridays, we provide you with resources, information, and tips to assist you in making the best decisions to improve your intellectual, your physical, and your financial wealth. Our goal is to improve your bottom line now and in the future. So today we are diving into something most people do not like to deal with, taxes. Today we'll share 5 tax tips that will actually save you money. Either they do this by lowering your taxable income or they reduce your tax bill. So tip number 1, don't miss your deductions. A lot of people take the standard deduction and then they move on, which is totally fine. But if you've had major expenses like medical bills, mortgage interest, or charitable donations, it might be worth itemizing. Even deductions can add up, and nothing hurts more than finishing your taxes and realizing you could have paid less, right? So today I'm going to share some deductions people constantly miss. One is the home office deduction. If you work from home, even part-time, you might qualify for a home office deduction. For example, you use a small room or even a dedicated corner just for work. Deduct a portion of your rent, your utilities, or your internet. Yes, that little desk that you've wedged between your couch and the kitchen might actually be saving you some money. Just make sure that the area you claimed is used for work. So unfortunately, your work from couch while watching TV, that setup, it does not work. Another one is state sales tax. This is one people forget all the time. So if you made big purchases like a car, furniture, or expensive electronics, you may be able to deduct the sales tax. That sales tax alone could be a decent deduction. Another one is the job search expenses. In certain cases, if you're looking for a new job in the same field, some related expenses may be deductible. Think resume prep, travel for interviews, things like that. Another one is charitable donations, those things beyond cash. Most people remember cash donations like church contributions, but they forget about other stuff, clothes, furniture, household items. Those can count too. For example, donating a few bags of clothes, donating them adds up. And you can also create some space in your closet. And the last deduction I'll mention today is student loan interest. If you are paying off student loans, you may be able to deduct up to $2,500 in interest. It's not enough to make you love your student loans, but it is something. The big takeaway, deductions reduce your taxable income. Don't rush your taxes because skipping deductions is basically like tipping the IRS extra, and they don't even say thank you. The next one is to track your income carefully if you have like a side hustle, freelancing, selling online, gig work. You need to track both income and expenses. That laptop, software, mileage, or even part of your home office, these can be deductible. The mistake people make is only reporting income and forgetting the expenses that reduce that taxable profit. Tip number 3, use tax advantage accounts. These tax advantage accounts, contributing accounts like retirement funds, health savings accounts, they can lower your taxable income. For example, putting money into a traditional retirement account today could mean paying less in taxes right now while also saving for the future. It's one of the win-win moves in personal finance. Tip number 4, double check your credits. All right, let's talk about these credits. Now, credits are better than deductions. And why is that? Because deductions lower your taxable income, but credits, they lower your actual tax bill, dollar for dollar. If you get $1,000 credit, that's $1,000 less you owe. Not theoretical savings, but real money. And yet, people skip these all the time. Why? Most of us hit that point like, you know what? Good enough, just send that return. But hold on, you may be walking away from money. Credits for things like education, child-related credits, or even energy-efficient home improvements. People often overlook these, and that's literally leaving money on the table. I'm going to run through a few common tax credits. One is energy credits. Did you install energy efficient windows, solar panels, or anything that made your house feel like it belongs in the future? Don't miss getting additional value for your improvement next time. An example is you spent $10,000 on qualifying upgrades. You might get 30% or about $3,000 back. That's good money. The next, education credits. There are 2 big ones that I want you to know about: the American Opportunity Credit and the Lifetime Learning Credit. These can help you get money back for education expenses like tuition, fees, and sometimes books. A quick example: let's say you or your college student paid $4,000 in tuition. With the American Opportunity Credit, you could get up to $2,500 back, and part of this credit can be refundable. So even if you don't owe much in taxes, you could still get money back. That's a big one. With the Lifetime Learning Credit, this one is a little bit different. Let's say you took a professional course, or you went back to school and you paid $3,000 in tuition. With the Lifetime Learning Credit, you could get back 20% of that. So about $600 off your tax bill. Not bad. Unlike some other education credits, this one is not refundable. So it can lower what you owe, but it won't turn into a refund if your tax bill is zero. Now, let's take one of the biggest ones, the child tax credit. If you have kids under 17, you may qualify for up to $2,000 per child. Yes, per child. So if you have 2 children, that's potentially $4,000 off your tax bill. And remember, this is a credit, not a deduction. So it directly reduces what you owe. Let's say you owe $3,000 in taxes, but you qualify for a $2,000 child tax credit. Now you only owe $1,000. That's not a nice savings. That's okay. Let me breathe again. And in some case, part of that credit is even refundable, meaning if you don't owe much in taxes, you could still get money back. It's not full reimbursement for raising a human being, but hey, it is something. The second one I talked about was the Child and Dependent Care Credit. It's another credit that a lot of people miss. This credit is for child care expenses. So if you're paying for daycare, a babysitter, or even summer camp so that you can work or look for work, this credit may apply. Let's say you paid $5,000 in daycare costs during the year. Depending on your income, you might get back 20 to 35% of that as a credit. So that's somewhere between $1,000, $1,750 back in your pocket, which is great because childcare costs are expensive. You know, roughly the price of a small spaceship. Now, a couple of quick notes. The care has to be work related. So if you need a nap, that doesn't count. Tragic, I know. And you'll also need to keep records, so keep your receipts. Between this and the child tax credit, your children might not be paying rent yet, but at least they're contributing a little bit. And now the last tip is to file time or file an extension. Don't ignore deadlines. Filing late without a plan leads to penalties. If you're not ready to file for an extension, it gives you more time to prepare your return properly. However, remember, an extension to file is not an extension to pay. An extension to file is not an extension to pay. So if you miss the deductions and credits shared here, or you need to update your return, filing an updated or an amended tax return is possible. You can correct something you already submitted, which is pretty good. But the rules are pretty specific, but manageable once you know the basic. So number one, use the correct form. Use Form 1040X. This form shows you what you originally filed, what changed, and the corrected amounts. Why should you amend? You generally file an amendment if you reported the incorrect income, you missed deductions or credits, you chose the wrong filing status, or you need to correct dependents. You don't need to amend for simple math errors. The IRS will usually fix those, for you automatically. So how long do you have to amend your tax return? You typically have 3 years from the original filing date or 2 years when you tax, which is a refund. So you can amend your return by e-filing nowadays, but some still require that you mail it in. You need to attach any new or corrected forms like your W-2s, your 1099 schedules, but be sure to clearly explain the reason for the change on your forms. So processing can take up to 20 weeks or more, and you can track it, which is pretty cool, using the IRS Where's My Amended Return tool. If you owe more tax, pay as soon as possible to reduce penalties and interest. These fees, they can eat up all of your savings, so be sure to do that. Also, remember, if your federal return changes, you may also amend or need to amend your tax return, but that rule varies from state to state. So as a recap, taxes don't have to be overwhelming. You just need a few smart habits. 1, check your deductions. 2, track side income and related expenses. 3, use tax advantage accounts to defer your tax impacts. 4, don't miss your credits to reduce your tax bill. And 5, stay on top of those deadlines. So I want to thank you for tuning in today. Hope you received something of value. Please like and share this broadcast. Subscribe to the YouTube channel. You can also catch the replay of this and find other great info on YouTube at Clara Lyons-Devaughn. Financial Fridays, we're here to provide you with the resources, the information, and the tips to assist you in making the best decisions. And here at Financial Fridays, we have ESP, expertise, solutions, patience, expertise, solutions, and patience before, during, and after the sale. After the sale, we assist sellers, buyers, and investors build wealth, and real estate professionals build careers in real estate. And people always ask, Clara, what is a Lyonsview lifestyle? Because we want that for all of you. And a Lyonsview lifestyle is when you actualize your dreams into reality. It's the possibility of what is available when your life is in order, when your finances are in order, when your mindset is in order, when your health and your spiritual mindset is in order. So my name is Clara Lyons-Devaughn. We stream Financial Fridays here at 9:30 a.m. Eastern Standard Time. And until next time, Keep living your very, very best life. And if you haven't done your taxes, file that extension. And if you filed your taxes and you saw something today that you might want to change, amend those taxes. All right. Have a great, great day and keep living your best life.